Hello, hello, everyone. Welcome to our show. Dave, I've been behind this window here laughing this whole time while the intro's been on there. So I apologize. I'm going to be laughing for a little while this morning.
Hey, no worries. You're going to be laughing even more once you realize what I was able to bring back from my trip this last week. Is that those that come on the show know I was not here last week. I was spending time together as a family. We've decided we don't call it vacation because with our two disabled children, you don't get a lot of time to yourself to really vacation. You just get to spend time together as a family. But I was able to bring back a special treat today that I'll get to share with you.
Okay, well, I can't wait to see this, Dave. You've been teasing it for a while.
Okay, well, if you're ready, let's get started. CR, I've got the emergency Bigfoot sound maker here. So if you need, if you need a big groan going on, if you need a howl. So anytime you need something, this Bigfoot emergency Bigfoot, then I've got it for you. So if you're out in the woods, going to go camping with some scouts or some young men, let me know. I'll send it over and you can use it on your trip.
Perfect. Well, I was hoping that might be some some audio for the podcast coming up next week.
Yeah, maybe we'll have to mix it in. Some of those during the little segments where we're transitioning out, we'll just put a big groan in there.
Where did you find that at?
So we stopped in Jefferson, Texas. Now, I didn't realize there was such a place as Jefferson, Texas, but it's really this cute little small town, less than 1,000 people, but they've kept the whole antique, old style city of the town. And they had a five and dime there that was just loaded with old stuff, different unique items. And we found that, and I thought, I've got to bring that back so I can share it with CR.
Well, thanks for sharing that. I'm going to have to get some of those sounds recorded so we can put it on our show as we get started every week.
Absolutely.
Well, I want to welcome all those who are with us live and those on replay. Also, thank you so much for being here. We are here every Wednesday, 11 a.m. Central Time, and we are talking all about retirement. Dave, like you said, you weren't here last week. We had Dr. Peter Lichtenberg with us from the olderadultnestegg.com. He was here talking, and it was great, Dave. We had some great conversations. We talked about elder abuse. We talked about so many other topics in this area that really hit home. And I know that's a passion of yours as well.
It definitely is. And I'm glad that Peter was able to make the show. I have such great respect for what he's doing and his efforts to really help educate the country on elder abuse items and things we need to be aware of with his multiple books, with his website, all the things that he's doing. So, yeah, I'm really glad he was able to fill in. What a great replacement for the time I was gone.
It's always great, Dave, when you're here, and I love having guests on also because it really just enhances the show and brings on so much, conversation in retirement. Because I feel like we just need to have more and more conversations about retirement, either with our loved ones, with those in our circles, because I feel like we just don't have enough of those conversations right now.
No, most people don't. They don't talk about the future the way they should. We get so bogged down in what's going on today, not really looking out to the future and the impact of our unwillingness to commit our time to that topic, what impact it's going to have on us long term.
Dave, we are again talking about retirement. A lot of different questions that have come in over the last couple of weeks. So I have loads of questions that are coming in. So I'm going to get started here so we can go through this. And again, if you are here for the first time, or if you're here because you love the show and you see all these great questions, we're glad that you're here. What we do is we try to answer as many questions as we can and have Dave give us all of his feedback on this. We really encourage you to submit your questions here live, either through Facebook or YouTube, and we'll do our best to get those answered as well. So Dave, if you are ready, I want to start throwing my first question at you today.
Yes, let's get started.
All right, my first one here is from Christine. Am I able to include a form of long-term care into a life insurance policy?
As long as it's a policy that you are putting in place now. Now, if you've already got an insurance policy that didn't include any long-term care benefits with it, you're not going to be able to add those on as an additional rider for most of you. In fact, I would assume all of you, there may be a chance that you could add a paid rider onto that policy. But there's really two ways you can do this. One is a paid long-term care rider, which I don't generally recommend. Generally, they're a little more expensive than just going out and getting a long-term care policy by itself. The other is the no fee chronic illness rider, where you're getting that benefit from the insurance company that's allowing you to get your death benefit early if you have a long-term care event and not charging you anything for it.
Dave, what happens if the long-term care benefits just go unused?
Yeah, the nice thing with a life insurance policy, as long as you're using the no fee product, is you get all the death benefits. There's really no benefit or consequence otherwise to you if you never use the benefits during your lifetime for a long term care event. If you've got a $400,000 death benefit on your policy, that's exactly what your beneficiaries are going to get. Now, if you had paid for the paid long-term care policy, there's a chance that all of that money you paid in to cover those costs, that's just going to get lost once you end up passing away without having had that event.
Dave, a lot of times in this space too, people are looking at this by saying, hey, this is very expensive, and we're going to try to take the least expensive route. And that typically is that self-insure against the risk. They start putting money away. And what you're saying, Dave, a lot of this is there's better ways if we prepare ahead of time.
There definitely is. And the problem is too many of us wait too long. The issue is many of these things that we're talking about from not only a long-term care side, but a life insurance side, they require some type of, good health to be able to get into these products. Now, they're two different products. Long-term care is based on morbidity. Life insurance is based on mortality. But still, you have situations. I was talking to someone the other day, and they're trying to solve a long-term care issue. They believe they're going to go into a long-term care issue because they're starting to have Parkinson's disease. They're having the impact of that. But it's too late. Once they got diagnosed with Parkinson's disease, you're not getting a long-term care policy. Now, could you potentially get a life insurance policy that would be able to be used as a long-term care policy using the no-fee chronic illness rider? Maybe, but probably not. Again, now you've got some underwriting issues. You've got some adjustments to your life expectancy there, and it's going to require some reductions from an insurance standpoint of benefits they'll give you for the amount of money you're going to have to pay.
Dave, since we're on this topic, I'm going to dive around it just a little bit because we have a lot of questions that are kind of in our area right now we're talking about. So the next one I want to bring up is from Tom. I heard housing is a big expense in retirement. Would moving to a retirement community help lower this expense?
Well, it depends on what you're talking about when you're looking at that retirement community. Generally, it's not cheaper. There's just more options for you to be involved with more people that are your age, maybe services for people that are having struggle with mobility, getting out the way they would like to. Maybe there's a community bus that's going to take you to events. Maybe they'll schedule stuff at the clubhouse that you can get together and play cards or have different activities. So I'm not sure that's going to cost you less. The biggest thing for most people that's going to help them spend less in retirement is getting a smaller home. I mean, hopefully, in theory, you'd be able to have a smaller amount in that home from a purchase standpoint, but your utilities will be less, your maintenance cost will be less. And, those are all things you need to look at. But just moving into a retirement community is not going to necessarily mean you're living on less money.
Dave, if we take a retirement community or we take a nursing home, a lot of people say, look, if you're there, it meant that you're just going to waste away until the end, right? You're just going to, it's inevitable that that's what you're doing there. You're there just to wait until the end. But does a retirement community, if you do that, or if you buy a home, does it give you a place of purpose? Does it give you something new?
For many people, it does. Again, if you look at most, I would call them 55 and older communities. If we're talking about a retirement community, that's what they're referred to by most companies out there that are marketing these communities. But again, you've got a situation where most of those living inside that community are going to be in a very similar position as you. It may not all be retired, but most of them will probably be retired, have extra time. You're going to have activities there. Usually these facilities will have some type of recreational activities, whether it be a swimming pool. Right, pickleball court now is a really big thing for those in retirement, as well as younger individuals. You may have tennis courts there. And then that clubhouse, again, oftentimes is used for various cultural events that are going to happen. So yes, by being in that community and being a part of a group that's really working to try to keep everyone engaged together and involved in activities, going to provide you a much better opportunity than, again, someone like me. If the neighborhood I live in, there's one individual that I know of here in my community that's retired that has all day to do what he wants. Well, the rest of us got to work all day.
Yeah.
And then most of us have kids. So if we're not working after work, we're dealing with our children. So for that individual to really interact with his neighbors at a high level, not going to happen so much as it might in a retirement community where you've got more time and more freedom.
And Dave, we'll have to dive in a little bit more because again, this is expensive. This is not a cheap option, and people are going to look at this when they get to retirement and think, I should have done something earlier.
Yeah, absolutely. And it's something that you've got to consider too. I mean, there's so many decisions with housing as we get into our retirement years. Most of us don't put enough time thinking about it. If you're in a home that's a multi-level, are you going to be able to get around the way that you should be able to get around? Even these 55 and older communities, do you get into a point where you've got a child that no longer can handle the expenses on their own? And so they're wanting to move back in with mom and dad, or mom or dad or whoever's still alive and in that house. Well, now you may not be in a position to be able to do that if they've got kids and trying to move them into that community. So, the services around where you're at, what is it you're truly looking for in your retirement? Can you get to the doctors and be able to get to the activities you want to participate in? All things we really need to consider, but most of us don't. We get in our home that we've had throughout our working years that we raised our children in, think, oh, this is going to be a great retirement home. There's so many memories. Well, really, it could be a horrible retirement home depending on the layout of the house.
So, Dave, I'll give one bit of advice. Just don't show up at your kid's doorstep with two suitcases and welcome yourself in once you get to retirement.
Yeah, don't do that. I'm sure it happens more often than we'd like to admit. But yeah, that's not the answer, is to just drop in on someone's doorstep.
Well, Dave, let me get to my next one here from Janet. Why is living a long time in retirement considered a risk multiplier?
Maybe the best way I can explain this, Janet, is to take an item that you would be familiar with. Let's take a car, for example. Most of us have cars. Shouldn't say everyone does. You live in a city where you can get around with a bike or through public transportation. Maybe you don't own a vehicle, but most of us at some point will or do own a vehicle. Think about that car. If you go out and buy a brand new car, what it costs $50,000 to get this car, probably not going to have a whole lot of issues with that car during the first few years. And if you do, you're going to have the warranties there to be able to cover that. But you own a car for 10 or 15 years, all of a sudden, things start falling apart. You've got a situation where the transmission may be going out, the engine's got problems, interior's got a bunch of wear and tear on it. Maybe the seats have wore out. Same thing really happens in our retirement. As we look at the length of time that we're living, it gives us a lot of years for things to go wrong. And that seems to be what happens in life. The longer we're in any situation, the higher chance we're going to have some type of problem. So that's why it becomes a risk multiplier, not only from our own health side, because our bodies are wearing out continually as we face death, but from a financial standpoint of sequence of return risk, tax rate risk, all kinds of adjustments can happen during that time. And we're going to be subject to the consequences of those.
So, Dave, what you're saying is the longer you live, the bigger all the other risks get.
Absolutely. Yeah, absolutely. And unfortunately, that's the big problem we're having with retirement right now, is we are living too long. Now, for most people, you say that's not a problem. I want to live as long as I can. But unfortunately, society say, no, that's really not what I want. And in fact, the other day I was talking to an individual that's really struggling to put the money together he needs to maintain the lifestyle he has, was trying to get my opinion. He had already talked to a bunch of other advisors on what he should do. And it was really hard to see that, I'm like, how long are you going to live? He's like, hopefully only till 70. And I'm like, well, that's not very old. He's 59 years old. I'm going, that's not a long time. He's like, but that's when I run out of money, Dave, because of my lifestyle. And I'm having a hard time adjusting my budget to fit into a different lifestyle. And that's sad to see, because again, you're going to have someone that had a really good lifestyle that could easily get into a position where they probably won't be able to maintain the home they still have, going to have to move into a much smaller home, may not be able to drive the same cars they've been used to. All these things are going to go away for the last 10, 15, 20 years of their life. And it's just sad to watch and see happen.
Mm-hmm. So if you want your money to last as long as you do, Dave, what you're saying is we need to try to reduce or eliminate longevity risk.
Absolutely. And we've got to focus more on income, not assets. This is the other problem that everyone struggles with, is we think we've got to have this whole bucket of assets. Well, you've got, just endless problems if you've got a bucket of assets sitting out there. you've got to be the one dealing with it. Well, if take Social Security, it's an income stream. Nobody sits here and worries every month about their Social Security. Hey, it gets deposited in my bank account on whatever Wednesday of the month my birthday happens to fall, getting that money right into my account. I spend it every month. And so we've got to really look at how we approach retirement. And unfortunately, most of us are approaching it incorrectly.
Dave, I like it too because you talk about because most of the tools in our average retiree portfolio, I mean, it's stocks and bonds, mutual funds, money markets, gold. Those don't guarantee income when what you're talking about here.
No, they don't. And you get in a situation where all of a sudden you need income and that's what you have. Well, guess what? You got to sell those assets no matter what the market is going to tell you they're worth. And oftentimes that may be selling at even a further discount because you've got to get the money very quickly. So it is a problem that the people have. And I don't know, it blows me away that we spend 40 years of our life, 45, whatever it is. Again, you go back, I guess, to our childhood when we're living with our parents, that it's even longer than that. But we spend our whole lives talking about income, living a lifestyle off of income. And then we get to retirement and most of us think, oh, if we have a bucket of assets, we're in great shape. Well, I'd much rather have that bucket of income coming in, not worry about the assets because the income will come month after month, year after year, decade after decade, and I can continue to pay those bills versus having to worry about these risks and that money running out that's happening for so many people.
Yes, I definitely agree. Well, Dave, let's keep moving on here. My next one from Scott. Should I keep a risky high yield investment as I get into retirement?
Scott, great question, and I'm happy to address this. Now, a lot of it's going to depend on your facts and circumstances. What part of your portfolio is this high yield, high risk investment? If it's 100% of your portfolio, I'd say absolutely not. That's not where you want to be. You don't want to be having your retirement out on the craps table where you're going red or black and whatever it turns out to be, well, I succeed or I have a miserable retirement. Now, if it's a small portion of your retirement and if you ended up losing the money, it's not going to have a high impact on your future ability to pay your bills. I'm not against having some high risk, high yield investments out there, but we've got to be very careful. If we're trying to hit our home run off of these risky investments to provide a better retirement, most of us are going to wake up with a no retirement by the time it's over.
Dave, I read this quote and I wanted to get your opinion on it, but this lady, Barbara, said, the riskiest day in your retirement financial life is the day you retire.
Yeah, I would agree with that because that's where you've got to now figure out all the decisions and what you're going to do. The roadmap you take from there going forward is going to impact the next 20, 30 years. Again, you make a lot of bad decisions there. This gentleman I was talking to the other day, and again, I bring him up because there's so many things that relate to so many people, but you looked at his situation, had a large bucket of cash that he received as he got out of his job because of some disability. He's blown through most of that. Again, this is what happens in our retirement. If you're looking at a bucket of assets, you think, I've got $1 million. Well, that's a lot of money. I've never had that much money. It's all built up over time. It's more money I've ever had. Well, maybe 100 grand to you doesn't seem like that much to take out of there. But then you take that 100 grand, that becomes 900. And then the next year you do it. And the next year, pretty soon, by 75, you're looking at the account, there's $50,000 left. And you're going, wait a second, I'm still really healthy. I got a lot of life to live. And there's nothing left. It's all gone because I took too much money out too quickly.
Dave, I hear a lot of these two hurdles in the retirement space. Should I be more aggressive with my investment in retirement? And if so, how can you protect these investments in my retirement? I don't know about you, but that seems pretty hard.
It is hard, and it's very interesting to see what's going on out there because, again, investment advisors, we all know that we have a major problem. Again, people do not have the money they need to get through retirement. It's just the reality since the 1970s when we switched to an individual-based retirement plan with IRAs and 401ks. We've done a horrible job of taking care of that responsibility. So many advisors, even out there themselves, are saying, look, you've got to take more risk to get a higher rate of return to get a better retirement. Well, that's all fine and dandy if you're going through the 1990s and you've got a decade where you put 100 grand in and it's worth 600,000 by the end of the decade. Not so great if you put it in at 2000 where we had 3 years of a down market. All of a sudden that money gets cut in half in a 3-year period of time. Or you look at even right now, yes, we had a downturn. It's been coming back, but many top economists I talk to believe that the next crash is going to happen very quickly. It's going to be far greater than this 20 or 30% we just experienced. So if we've got all of that in the market, we're subject to that risk. Again, are we willing to take that over a lifespan of 20, 30, 40 years? Because that's going to happen. Markets go up, markets go down. And if you're on the wrong end of when that happens, your retirement's dead. It's in trouble.
Dave, what do you say to those who are essentially playing catch up? The ones that are getting more aggressive later in retirement because they just haven't saved enough?
Yeah, the biggest thing that I can tell them is they've got to cut their spending. I mean, that's the problem. Everybody wants to maintain the same lifestyle that they had and then somehow get more aggressive and do magical things with their retirement that others didn't do, that were responsible and put the time in and the money to make these things happen the way they should. The reality, the biggest problem I see with most people is they just have too high of a budget and expectations, and therefore it creates problems on both ends because, again, now you're overspending. So now you got to be more aggressive in your retirement growth. And as a result, you put yourself at much higher risk of having other problems.
Well, Dave, let's move on. My next one here from Jamie. How do IRAs work after retirement?
Yeah, good question. So as we look at the individual retirement account, and we're going to talk about traditional accounts right now, and then I'll talk a little bit about Roth accounts. But basically, it's going to sit there, continue to grow. Once you get 59 and a half, you would be able to pull money out of there without having to pay any penalties. Now, you would pay a tax on there. But once you reach age 72, you need to understand that you're going to be required to take money out of that account for the rest of your lifetime. The government's going to expect you to take a certain amount. This year, it starts at 3.65% for those who turn 72 in 2022. And then it increases from there. The older you get, by the time you're in your 90s, it's 14, 15, 16% you're having to take out of that account. And then once you die, the other thing you need to understand, if you have anything left in there, going to go to your beneficiaries, assuming your spouse has passed away as well. If you're married, going to go to your kids, and then they basically have 10 years to be able to liquidate that account, and will end up paying tax on whatever's left in the meantime. So that's the way the traditional account works. The Roth account's much better. Get the money in the Roth. There's no required minimum distributions. You can allow it to grow all you want. If you don't need the money, let it grow tax-free for the rest of your lifetime. And then once you transfer it to your kids, if they're the ones who end up with it, they get it tax-free as well. So again, you've got to look at what you're trying to accomplish. What do you believe tax impact is going to be in the future? But that traditional IRA is not going to just sit there and allow you to have freedom to do whatever you want with it. Government's going to give you a lot of direction on what they expect you to do. And if not, you're going to pay some heavy excise tax on it.
And Dave, what mistakes are you seeing people make as we're getting, as they're getting into their Roths or traditional IRAs? I feel like there's a lot of things that we deal with here, but there's special things that you're looking at to say, hey, these are some mistakes, and this is how to avoid those.
Yeah, as hard as it is to say, what we find or what we see is people do nothing or they do too much. And that's really hard to say. You're like, okay, we want people to take action, we want them to do something, but we've got that group that says, hey, I'm just going to do nothing right now. I'm going to put my head in the sand. I'll put some money in the account. Hopefully it turns out okay. Not going to look to the future of what tax rates and other risks I might have. And then we've got others that panic and all of a sudden want to transfer $1 million. And we've seen people do this where they've taken $1 million, $2, $3, $4 million. In fact, we had someone the other day took $5 million on their own accord and converted it all in 1 year. Well, in their situation, that wasn't the best decision they could have made. Now, some situations, if you got high income, you're going to be in 37% bracket the rest of your life. It may be a great decision. But in that situation, it was not the right decision, but they panicked. And so they went too fast. Well, we've got time to be able to make the transition. So what we've got to do is just slow down and realize, hey, it doesn't all have to be done overnight. We can allow this to happen for a number of years. And if we will, we can get ourselves where we need to be in a much more efficient place than we would have otherwise gotten to.
Such great advice. And I do want to remind those that are with us live, go ahead and submit your questions in our comments. It doesn't always have to be on the topics we're talking about, because Dave is here to answer or at least discuss with you about your retirement topics. And Dave, I bring that up because a lot of times we get questions on here, things that you have not dealt with or things that you see coming up as newer areas of focus. And what do you say to those who come on and submit these questions sometimes because things are even new in this case?
Yeah, the biggest thing is to keep getting your questions out there. Again, there are going to be situations where we may or may not be able to help you through the process based upon what's going on. We've got a lot of law changes that are happening right now, and we do our best to keep up with what's happening there. We obviously there's information out there that we may not be familiar with, but keep asking your questions. Allow us to help you through the process. If we don't know, very good at doing research, trying to help you get the appropriate answer so that you can make the right decisions for yourself moving forward.
I love that, Dave, because that's what we're here to do, is here to help you take action, help you to get closer to your retirement. So it's either, hey, you're going to plan for your vacation or you're going to plan for your retirement. And that's really what we're coming down to see right now.
Yeah, it absolutely is. And again, I appreciate those that are on the show, that listen to the show afterwards, that give the time to be able to make the decisions for the retirement, to take the time to do that.
Dave, let's get one more in here. Might be able to squeeze a few more. Let's get Evelyn. Why may my tax bracket be different in retirement versus what it was in my working years?
Yeah, great question, Evelyn. A couple of reasons when we look at it, and a couple of things we need to be aware of as we're getting into our retirement years. Most people are under the false assumption that because we're in retirement and because our gross income is lower, we're going to be in a lower tax bracket. Well, if you just took gross income, for most people, you would be in a lower bracket because most of us are not living off the same amount in retirement we did during our working years. In fact, it falls in about 70 or 80% of what we were doing during our working years. So if you just took simple math, you'd say, well, it just makes sense. If I was making 100 grand, now I'm living off 70 or $80,000. It's coming out of an IRA that I'm getting taxed on. I should be in a lower tax bracket in retirement. The problem is you had a whole lot of deductions during those working years that you don't have during your retirement years. And for many of you, one of the largest tax benefits you had was your contributions into your retirement accounts. If you had a 401k this year, you could have put in $27,000 if you're 50 or older. If you're married, 54,000. That's a huge tax benefit. So again, when you look at Evelyn, the reason that it's going to be different is because you'll lose deductions. You're also going to have Social Security tax that wouldn't have been taxed during your working years because you weren't receiving the Social Security, all kinds of things that need to be looked at. But again, please do not fall into the trap that I see so many people fall into. Gross income went down. I'm going to be in lower bracket. Why should I ever do conversions now? Why should I ever plan for anything different than just paying low amounts of tax in retirement? I'll tell you, as not only a financial advisor, but as a CPA, I see this on tax returns all the time. And most of my retirees complain about the taxes they pay. It's not they're coming in going, oh, I'm so glad I'm paying so little tax now I'm in retirement. Not that way at all. They're paying a lot higher bills than they expected.
And Dave, let's talk about taxes going up. Is that still something that you're looking at and really getting information on?
Yeah, absolutely. We know that January 1st, 2026, they're going to go back to what they were in 2017, which means we are going to have a small increase. But 2030, folks, I don't know how we pay for this. Again, we've proven the modern monetary theory does not work. It has to be in an environment with no inflation, but yet it creates inflation. So you've got a rock and a hard spot. You've got a catch-22. It's like this is not going to work, but yet we continue to spend and we continue to overspend and we continue to go further in debt. Well, what does that mean? That means in a situation in the future, we're going to have no other option but to raise taxes because that's the only way the government will have to raise additional funds to pay for the goods and services that we're wanting to have. And I don't get it. I mean, again, I realize we all want something for our dollar, but it's very unfortunate that right now, again, we should be talking about how are we downsizing government? How are we putting taxes in place to reduce the debt? Instead, it's this side of saying, oh, we're just going to add more taxes and give you these goods and services. Well, and you got to understand right now, it's the rich people that are getting taxed. Pretty soon they'll be at a point they can't get taxed anymore. And the goods and services that you haven't yet gotten that you want to have, you're going to be the ones paying for those. So again, don't get caught into the fact that that bill's someone else's and not yours. And therefore it's not a problem. The day will come where that will come back and affect all of us.
I definitely agree. Well, Dave, we're almost out of time, so I do want to bring up one more piece here. Tell me about this Getting Safely Through Retirement webinar. In fact, you have one coming out today.
I do, and I'm very excited about it. Last week, we had a class. I didn't get to teach it. We ended up running a recording of the class, which we very seldom ever do, and I'm excited to be back. It's a class I teach every week. It is our flagship presentation. This is where we talk about the top 10 financial risks you're going to face in retirement. This is where the rubber hits the road, folks. This is where you can get your eyes open of what's really going on in your financial future and the things you should be aware of that you need to spend time on trying to improve and get into a better position with.
And this is a 2-hour webinar. And if you are a CPA, you can get CPE credit, and you can go over to retirementriskadvisors.com /safe, and you can get all the links there for it, or you can go to our event page at Retirement Risk Advisors. And if that webinar doesn't work, we've got a whole lot of other webinars you can be part of. But Dave, you said this is a flagship. This is the special one. This is the one that you really have a good time teaching.
I love teaching the class because there's so much information there that opens people's eyes. We get a ton of questions through the process, and something like Medicare, something that most people don't give any thought to, that they're just going to get Medicare when they turn age 65 and everything's going to be wonderful. It's not that simple. Elder abuse. You talked about Peter and his knowledge that he shares. Love talking about elder abuse because 1 out of every 20 retirees is going to be subject to it. Long-term care, 35% chance that any of us during our working years will end up being permanently disabled. Folks, these are high-level risks, and we are able to walk through, identify what they are, give you strategies to help fix them, and then show you a case study that helps you understand how big of an impact they can cause and how much money you could leave on the table if you end up doing it incorrectly.
And again, you can find that at retirementriskadvisors.com /safe, or just go to our website and click on the events page. And if you did not get your question in today and you have a question that you're just burning to ask, go to our website, go to the contact us page, go ahead and submit your question there, and we will get those on future shows. It's really important we get. I was like, did I hit something?
Just trying to help you out, CR.
Oh, I love it. I need to get one of those.
So for those of you that just joined the show, I've got my emergency Bigfoot. If you've been a follower of the show, you know that CR and I, it's a joke between the two of us. Anytime we go anywhere where there's Bigfoot shirts, Bigfoot paraphernalia, we're going to get it and come back and share it with the other.
Oh, I love it. Well, again, everyone, thank you so much for being here with us and Bigfoot, and a part of the retirement space. And again, we'd love to see you on a future, our future show. We'd love to see you at a webinar. And again, don't forget, we have our podcast. A new episode comes out every single Friday as well. And Dave, thanks again for your time. And we will see you and Bigfoot next week.
Sounds good.
All right. See
Bye.
you guys.